Welcome to step 7 to 10 of the accounting process. So this is already the episode 8 of this particular series. So if you did not yet see the previous episodes, please go to the description because their links are found there. Don't worry because the episodes are short, and if you ever decide to see, for example, episode 1, at the end of that video, there will be a suggested video that will lead you directly to the next episode. So if you are through with the previous episodes, then let's get started. Let's start this video lecture with step 7, which is the adjustments are journalized and posted. But before that, I would like to emphasize that these steps that we are to talk about will directly be applied on the only illustrative problem considered in this whole set of series. So this problem was introduced way before. I think it's on the episode 2 of this series. Anyway, this step 7 is easy. Why? Because we already have the adjustments. So they have been prepared in the completing the worksheet episode of this series, or episode 6 if I'm not mistaken. To help you remember, these are those adjusting entries. So the only thing left to do is that we should post this on the ledger or T accounts. So in completing the ledger episode or episode 4 of this series, we have this particular T accounts. Now, what we need to do is just to post this to here. And to make that happen, let's rearrange this a little bit into this one. Now, let's post. So we have here debit rent expense of 6,000. But since we don't have any T account yet for the rent expense, so let's make one. So we have here the rent expense, and of course, we need to debit 6,000. And we need to get the total of 6,000 also, because there are no other entries related to rent expense. But don't forget the credit prepaid rent. So we need to credit 6,000 here. So what will happen is the total of the prepaid rent from 15,000 will only become 9,000. Next is we have the debit supplies expense 16,500 and credit supplies of 16,500. But since we don't have any T account for supplies expense, so let's make one. So we have here the supplies expense 16,500 and the total is 16,500. And don't forget the credit supplies of 16,500. So we have here the supplies already. So you just need to credit the 16,500 and the 20,000. The previous balance minus the credit of 16,500, the supplies is now 3,500. And of course, we have the third one, the depreciation expense and the accumulated depreciation. Both has no T accounts yet. So let's make one for each of these. So we have the depreciation expense here and the accumulated depreciation here. The fourth adjusting entry is salaries expense 3,000 and salaries payable 3,000. Luckily, we already have a T account for the salaries expense. We have here the 30,000. So we're going to add the 3,000 right here and it will become 33,000. The problem is we don't have any T account for salaries payable. So let's make one. And the balance will be 3,000 credit. The fifth adjusting entry is debit accounts receivable. So there is no T account yet. So let's prepare one. So we have debit 5,000 and credit service revenues of 5,000. So we have here the service revenues already. We just have to add the 5,000. And lastly, we have debit unearned service revenues of 16,000 and credit service revenue 16,000. So we have both these accounts already. So we have unearned service revenues. So we have just to debit the 16,000 and it will become 64,000, which is 80 minus 16, and credit service revenues of 16,000. We put it right here, and because of this, the updated balance of the service revenues will now be 61,000. And that's it for posting adjusting entries. Now some of you will ask, what is the effect of the journalizing and posting of the adjustments? Well, to answer that, let's have the adjusted trial balance of the worksheet. So we have here the worksheet, the 5th and the 6th columns of the worksheet specifically. Now, observe the balances here in the adjusted trial balance and compare it with the balances here. It coincides, right? Like for example, we have a cash here of 87,950. We also have 87,950. The prepaid rent is 9,000 here, and it's also 9,000 here. So that's the effect of the step 7. Actually, before we posted these entries to the T accounts, the balances of the T accounts before coincide with the balances of the unadjusted trial balance. But after these have been posted, the balances of the ledger became the balances of the adjusted trial balance. So that's the effect again of step 7, which is journalizing and posting the adjustments. Now, let's go to step 8. Step 8 is closing entries are journalized and posted. But before we go to the closing entries, let me tell you that there are actually 3 types of journal entries that you need to master in the accounting cycle or accounting process. So the first one, we have the journal entries from regular transactions. So we have our example right here, and these entries were extracted from the episode 3 of this series, which talked about posting journal entries to the ledger. The second set of entries, which you are familiar with, are the adjusting journal entries, which we have posted to the ledger a while ago in step 7. And the third set is the closing entries, which is composed of 4 entries. The first entry aims to close the income statement accounts with debit balances, or in simple terms, this closes the expenses of the company. But how do we close it? Since the expenses is a debit balance, we can close it or make it zero by crediting all of those expenses with a corresponding debit on the income summary account, which is a new account title again. To visualize that, let's apply it to our illustrative problem. So we have here the income statement from the previous episode. So let's get these expenses of the company. We have here the supplies expense, the salaries expense, the rent expense, depreciation expense, utilities expense, and miscellaneous expense. Let's credit all of them, and the total of this one will be debited in the income summary account, and the total is 78,533.33. So this is what the first closing entry looks like. The second entry is the opposite of the first entry. The second entry aims to close the income statement accounts with credit balances. And in our illustrative problem, we only have one account, which is the service revenue account. To close it, we are going to debit the service revenues of 61,000 with a corresponding credit to the income summary account of 61,000 also. So that's it. But before we go to the third closing entry, let's get the running balance of the income summary account. So here we have 78,533.33 debit, but we have a credit here of 61,000. So the difference is 17,533.33 debit. So is this familiar? Yes, of course. So this is the net loss right here, right? So if we analyze, the first and the second closing entries just summarizes the expenses and the revenues in one amount, which is the net income or the net loss of the company. And that net income or net loss of the company can be seen on the balance of the income summary account. The third closing entry is the closing of the income summary account balance to the capital account of the company. So in our illustrative example, we have again a debit of 17,533.33 in the income summary. So to close it and to make it zero, we have to credit the account for the same amount with a corresponding debit to the Gletzmar capital for 17,533.33. And that's the third closing entry. And the fourth closing entry is focused on the closing of the withdrawal account. And since in our problem, the owner withdrawn 25,000 for personal expenses, I hope you can still remember, so there is a debit balance of Gletzmar withdrawal for 25,000. So to close it, we need to credit it, and we have to debit the Gletzmar capital for 25,000. And that's it for the 4 closing entries. Others of you might ask about what is the purpose of the closing entries as a whole. So to answer that, The objective of these 4 closing entries is to close the expenses, revenues, and withdrawal accounts to the Gletz capital account, which is similar to what happened on the statement of changes in equity that we have made in the past episode. Actually, after considering these closing entries, the capital account balance or the Gletz capital here in our example will have a balance of this one, 57,466.67, but you can check that out later. So again, these are the 4 closing entries, but we are not yet through. We still need to post this to the ledger, and that's up next. So now we are now on the posting of the closing entries, these closing journal entries to this particular ledger. Now let's start with the income summary. Debit 78,533.33, and since there is no T account for the income summary account title, then we need to make one, and there you go, we have the debit 78,533.33. Now we need to close the accounts like supplies expense. We have to credit 16,500 and it will be closed, and followed by the salaries expense, credit 33,000 and it will also be closed or become zero, followed by again the rent expense, credit 6,000 and it will be reduced to zero. We have also the depreciation expense, we're going to reduce that also to zero, and the utilities expense, credit 19,750, so it will become zero also, and lastly the miscellaneous expense. Now let's go to the second set of closing journal entries, which service revenues debit 61,000. Now the service revenues will have a zero balance, and credit the income summary by 61,000. But before we go to the third, the income summary again, after the 2 closing entries, will have a balance of 17,533.33 on the debit. Now let's go to the third closing journal entry. So debit Gletz capital 17,533.33 and credit the income summary, and if you credit that, then the income summary will have a zero balance already. And lastly, we have the fourth, which is we're going to close the withdrawal account to the owner's equity account. So debit Gletz capital 25,000, put it right here, and of course the Gletz capital will now have a balance of 57,466.67, which is the same with the equity balance in our statement of changes in equity that was prepared in the previous episode, as I've told you. Now let's credit the Gletz withdrawal 25,000 and it will become zero. So that's it for posting the closing journal entries, and that's it for the step 8. Step 9 is coming up next. Step 9 is the preparation of the post-closing trial balance, which is just a listing of these updated balances. So to make it easier, we should eliminate those account titles with zero balances. So here you go. Now let's make the post-closing trial balance. So let's start with the company name followed by the word post-closing trial balance and the date covered. So let's start with cash. So the cash is 87,950, followed by the accounts receivable of 5,000, and then we have prepaid rent of 9,000, and then we have the supplies of 3,500, and also we have the office equipment of 30,000. However, there is an accumulated depreciation, so let's put it on the credit 983.33, and those are the assets. Let's go to liabilities. We have the accounts payable of 10,000. We have also the unearned service revenues of 64,000, and we also have the salaries payable of 3,000. And lastly, we have the Gletz capital. The Gletz capital is 57,466.67. So that's it for the post-closing trial balance. However, we need to total the debits and the credits to end the post-closing trial balance. So we have 135,450, both the debits and the credits. So that's it for step 9. Let's go to the last step, which is all about the reversing entries. So to be direct, let's answer the question, what journal entries are to be reversed? And the answer is the adjusting entries, but not all of them. But before we go to that, here is a slide from a previous video of this series which shows the items to be adjusted and the adjusting entries. So these red colored fonts are the adjustments or the adjusting entries. So which of these entries should be reversed? So let's start with the doubtful accounts expense. So the doubtful accounts expense should have no reversing entry or should not be reversed, as well as the depreciation. However, if we're talking about accruals, both the accrued expense and the accrued revenues must be reversed. But how do we do that? Let's just debit what was credited in here and credit what was debited in here. So it looks like this one. Sir, how about the deferrals? To cut the story short, the adjustment for deferrals under the revenue method and the expense methods are the only ones that will be reversed, and it will look like this. So, adjustments under the asset method and the liability methods shall not be reversed. Now, let's answer the question, when will you prepare the reversing entries? Reversing entries are prepared at the beginning of the next year. And that's it for step 10. However, some of you might be wondering, why do we need to make reversing entries? To answer that, let's have an illustration. And by the way, before we start, I have to tell you that preparation of reversing entries is optional. Now, let's have the illustration. This particular illustration is related to an accrued salaries expense. We have ABC company pay salaries of 50,000 per 15 days every, number 1, 20th of the month for services rendered by the employees on the 1st to 15th of every month. And the second payday is every 5th of the next month for the services rendered by the employees on the 16th to 30th or 16th to 31st of the month. Of course, the salaries of 50,000 for December 16 to 31 20x2 shall be accrued by the company on 20x2 or at year end. But since it will only be paid on January 5 20x3, which is the next year, then this will be a very good example for the use or the logic for reversing entries. Now, let's make the entries first under the assumption of without reversing entries. So since the expense was incurred on December 16 to 31, there will be an adjusting entry for the accrued expense, which is salaries expense debit 50,000 and credit 50,000 salaries payable on December 31 20x2. On January 1 20x3, there will be no entry because the assumption again is that there will be no reversing entry. So the entry on January 5 20x3 should be debit salaries payable 50,000 and credit cash 50,000. The problem with this one is this: as an accountant, I would like to make only one type of entry when paying for expenses, and that is debit expenses, credit cash. As you noticed, that didn't happen here in January 5 20x3 because the entry is debit payable. Now, what if you forgot that there is actually a payable from last year? In the real world, there are a lot of accrued expenses every year end, and because of that, you tend to forget and will likely make the default entry of debiting expense and crediting cash, which will make your entry wrong. In this case, if you forgot, instead of debiting salaries payable, you will debit salaries expense at 50,000. And if you think about it, there will be two entries of salaries expense 50,000 already. One is from 20x2 and one from here, which is wrong, which is why I prefer to have a reversing entry. Now, let's check why. Let's assume the same problem but this time with the reversing entry. So on December 31 20x2, we will have the same entry with this one. However, on January 1 20x3, we are going to reverse it. So we have debit salaries payable 50,000 and credit salaries expense 50,000. And here's the beauty of it. On January 5 20x3, you can have the standard entry without thinking about the payable in the last year. So you can debit salaries expense 50,000 and then credit cash for 50,000 also. And it would still be correct. Why? As you can see, the salaries expense should be recorded in 20x2, right? Because it was incurred in 20x2, which we did. And even if we debited salaries expense on January 5, 20x3, it is still correct. Why? Because it has been negated by your reversing entry. So your debit here has been negated by this credit right here. So that's the logic and the usefulness of preparing reversing entries. So this is the end for this video lecture. Please click like, subscribe, and hit the notification bell for more updates. Thank you.